Good morning. My name is Shaun from Berg. I'm from PSG Online. I head up Investor Education. I've been given the topic size matters. So when I was given this topic, I thought, okay, how can I grab you guys' attention? So I thought the best way to do that is to refer to Gareth Cliff from 5FM. They did a poll about 2 weeks ago, and they asked the question, does size matter? And 41% of the poll said that it's got to be big. So 41%, sorry, 99 votes said size matters. But 59% of people said that it's not the size of the boat, it's the motion of the ocean. So have I got your attention? So what they basically said was, it's how you perform. Not the size that matters. So, but the topic today is size does matter. So here's my little agenda. I'm going to talk about size, but when it comes to the market, we talk about market capitalisation, the size of the companies. And there's three kind of, call it categories. We've got the large caps, we've got the mid caps, and we've got the small caps. So don't think of it as a podium. We just had the Olympics. Don't think of them as third place and second place and third place. Think of them as all different categories, and there's winners and losers within each of those categories. And the idea is that, I use the analogy, how do you start out being a big oak tree? You start out as a little acorn. So this is the same principle here. So my topic is that investing in mid caps and small caps is a viable investment opportunity. But how do you select a potential winner? And that's what we're going to talk about today also. Okay, so it's not only size, it's how you perform. So, definition of market capitalisation. It's calculated by multiplying the number of shares in issue when a company first listed shares. Okay, the number of shares in issue multiplied by the current share price. That's how we get to the size of the company. So the example, the biggest company on the stock market right now, anybody know? What's number one? Okay, Anglo, anybody else? Okay, the company called BATS, British American Tobacco. Okay, that's the biggest company in the market. This is until Tuesday. They were worth just over 900 billion. So just under 1,000 billion. I always wanted to know what is 1,000 billion. Is that what they refer to as a $1 trillion company, trillion rand company? At this point in time, they've just got over 2 billion shares in issue, and on Tuesday's closing price, they were trading at just over 450 rand a share. So, number of shares in issue, multiplied by current share price, that's how we get the size of the company. So that's number one. If you had to break it down, the rest of the market, so say number one is BATS, British American Tobacco. The top 40 stocks is what we refer to as the top 40 or the large cap stocks. Number 40 is Mr. Price. Now Mr. Price has just moved into the top 40. Okay, they're worth, well, the size of the company right now is just under 32 billion. Okay, they moved into number 40, into the top 40. An African bank has dropped out. They've dropped from the top 40 into what they call the mid cap, the next 60 companies on the market. Okay, you just here we go. So what do you call the mid caps or the next 60 companies? So that's from number 41 to number 100. Number 41 is Liberty Life or Liberty Holdings. They're worth about 28 billion. And the smallest one there, or the lowest one on the top 100, is Invicta, 5.9 billion. Now, anything that's not in the top 100, we refer to as the small caps. Now, the small caps from 101 to 360 can go from Gold One, which is a gold mining company, to Weta Breweries, as small as 338 million. So that's basically the market. This is the ordinary shares. I've excluded what they call preference shares, because most of the shares that we're trading with are ordinary shares, different kinds of classes of the shares in the market. So these are just ordinary shares. There's about 360 of them out there. Okay. So let's talk about large caps in a bit more detail. These are the institutional stocks. Obviously, the pension funds and unit trusts, these are the ones they invest in. Okay. They are free dealing, they are very liquid. These are the shares what we normally refer to as blue chip shares. Blue chips come from the expression of good old casino table. Was the big blue chip was the most expensive share on the poker table. When it comes to the shares, These are consistent, reliable companies, been around for a long time. Most of the time it's household names. You'll see when we refer to some of the brand names just now, you'll recognize them. And most of these shares in the top 40 are what they call rand hedge stocks. They benefit from the weakness of the rand. Okay, so either they have operations offshore, like British American Tobacco, a very big company worldwide. Either that, or it's a local company that exports, like our miners and our gold miners, our platinum. But they export and they take advantage of a weaker rand, so they benefit from the rand. That's why we call them rand hedge stocks. So most of the shares on the top 40 are rand hedge. If I had to break them down further, out of the 40 stocks, 12 of them are mining or resource related. Okay, 90 of them are industrial shares. So you've got your SA breweries, your British American Tobacco, your Richmonds, all those kinds of or the rand hedge stocks. You also got all the financial shares, the banks, or the banks as such, or the listed property companies, or the insurance companies. So that's what makes up the top 40 stocks. Okay. If I were to show you the list of shares, you feel, wow, geez, there's a lot to choose from. So I know these, they look a bit small. Obviously, I try and fit everything onto one screen. But just understand there's 40 stocks in the top 40. And out of that, that's what you're going to choose for a long-term investment. And some of you might have not know some of these companies, but if I were to show you the brand names, or the logos, you recognize them. You know, you've got Standard Bank, you've got Vodacom, you've got Sunlam, Tiger Brands, you recognize, the men who recognize breweries, especially SAB Miller, MTN, we go so far as Sasol. So these are the shares that all of us know. We've heard of these companies. That's what I refer to as a household name. Okay. On the left-hand side of the columns is the share codes. Okay, we need to know the share codes in that. But that's what makes up the top 40. I'm not here to talk about the top 40. I'm here to talk about the next group of shares. By the way, this is the performance over the last 10 years, from the 13th of October 2002 till now this week. Okay, the top 40 index, when they first started out, well, not when they first started out, over this comparison, back in 2000, they did go negative. Okay, you were losing money in that sector. They were down 24% for about a year, and then we had this recovery. But over the last 10 years, you've seen the portfolio, or that group of shares, grow by more than 261%, which is roughly about 26.1% per year. Then see the attractiveness of the unit trusts and things like that, because that's their benchmark. They're trying to outperform the top 40 index. That's not too shabby. You're outperforming inflation by a far margin, and as I say, you're doing okay. Okay, remember these are safe shares, been around for a long time. You're not going to lose your money. You're not going to go into liquidation, these kind of shares. Okay. Let's talk about the, sorry, the final slide. Let's just give you some of criteria regarding valuation. Now, don't buy a share on price, buy a share on value. That's one of the quotes from Warren Buffett. Have you heard of Warren Buffett? Okay, #1 investor in the world. He's a value investor. Price is what you pay, and value what you get. That's what he quoted. Okay, this is what we call the PE ratio. It's the earnings, earnings divided by the. Let me just get this right. Other way around. It's the price divided by the earnings, by the profit. That's where we get a PE ratio. It's a multiple. At this point in time, the PE of the market is about 14. We've been as high as roughly about 18. We've been as low as about 9. So we're around about the middle at the moment. If you want to compare it with the mid caps and small caps, that's the idea. Is it cheap or expensive? This is what they call the earnings yield, which is the inverse now. So earnings divided by the price as a percentage. So you can compare it loosely to a return you get in the banks. They're giving you roughly about 7.2%. Put your money in the banks, you're getting 4 or 5%. This directly gives you a better investment. And this is what they call dividend yield. Part of the profits gets paid out in the form of dividends. And we're talking about 3%. Okay, until recently, I think it was about 2-3 months ago, we didn't have dividend tax. Dividends were tax-free. Now we have a 15% what they call dividend withholding tax. But you're still getting 85% tax-free. You're talking about 3%. That's the average of the market. Between 2.5% to 3% of dividends. So you want to try and find shares giving you much more than that. Yeah. So that's the top 40. By the way, the performance. This is the actual graph. The blue line will be how the shares been performing over the last year or 2 years. And then at the bottom here, I've got what they call relative strength. I'm comparing the top 40 index relative to the JSE all share, the whole market. You can use the analogy of a horse race. if you had an opportunity to bet on a horse race, halfway through a horse race, which horses would you like to bet on? Horses near the front, near the middle, or near the back? We're going to go to the potential winners. So this graph shows you the potential winners. When this graph is going straight up, you're going with the potential winners. It means this share or this sector is outperforming compared to the rest of the shares. This year, in this situation, okay, the index, remember, it's an index, a group of top 40 shares. You see the graph's been down for the last about 2 years, and slowly it's been turning around. A lot to do with the rand being weaker the last few weeks. Okay, it's starting to turn around. So yes, the graph might be showing up, but it's also showing you that right now there's opportunity somewhere else. In other words, you're betting on the horses here in the middle or near the back. The horses better, there are opportunity somewhere else. Okay, so here's the mid cap. This is the next 60 companies. This is what I want to focus on. Mid caps, you can see obviously a much bigger group of shares. The list is a bit smaller in the sense that you can't read the writing. But there are 60 companies on that list. You might recognize still some of the companies. You've heard of JD Group, Joshua Dole. You've heard of Alova Sugar. All of you, hopefully, you've heard of Capitec Bank, and Spar, and Santam. But now you guys start getting things like Grindrod. Some of you might have never heard of Grindrod. Never heard of Roynoit. You've never heard of Wilson Bailey, okay, or Trencor. Now this is the idea, what I want to try and get across to you. This is under the radar screen of the institutions. They're not looking at the mid-cap stocks, mainly focusing on the large caps. But these are the potential future large caps, like we saw with Mr. Price. They've moved into the top 40 index. They go to the top, onto the radar screens of the institutions. So these are under the radar. They're good quality companies. Some of them are undervalued, and this is what presents the opportunity. This is the performance of the mid-cap. Over the last 10 years, same period as we saw now the large caps, when we were at 26% per annum, much higher performance. They're smaller, they're more nimble, that's why you can get this kind of performance. 49.7% or 497% over the last 10 years. It's not too shabby, huh? Okay. You see the PE, we're slightly lower. Okay, remember the market, it was 14. Anything below 40 would be considered cheap. So if you had to compare the mid-caps to the top 40 index, there's better value in the top 40 right now. Sorry, in the mid-caps. PE, the earnings yield will be the reciprocal, the inverse. The yes will be slightly higher, okay, 7.5. And dividend yields roughly about the same, 3.2. Okay? That gives you a bit of a valuation. You see how it's been performing the last year as such. That's where all the activity has been happening. People have been rushing out and buying into the mid-caps. Okay? Opportunities. Remember, a lot of the companies in the large caps, I forgot to mention that, we saw ShopRite and the Pick and Pays and those kind of companies. Those have been the darlings of the market right now. But they're expensive. They're not very, they're overvalued. And yes, we see the Spars and these kind of companies in the mid-caps. Maybe that's why I've been running. Okay? But on a relative strength basis, you can see it's starting to slow down. Okay, so these muscles, if we starting to move, the horses moving from the front, we're starting to move to the middle. Okay, so this is movement of funds the whole time. Here's the small cap index. Now the small cap index, obviously, there's 260 shares here. There's a much bigger pool of shares to look at, bigger market. Now, most of the shares you've never heard of some. You've heard of Spur, we eat at Spur. But some of us never have heard of Austra and Kajima and Astro Foods maybe, the chicken company. Okay, but Urbicon and One Logics and Supergroup. So these are really under the radar. But these is where, as I say, these are the future acorns, these are the acorns that will become the future oak trees. Okay, and this is where you and I as small private investors get excited when we start looking at these kind of shares. Okay, you see the performance here? Talking about 55%. So even better than the mid caps and much better than the top 40 stocks. Okay? Obviously, this is past performance. There's no indication of future performance, but it just shows you the track record, the potential you have by investing in these small cap stocks. On the valuation basis, yes, we've gone a bit higher. We're about 14 on the PE, so very similar to the top 40 index right now. On the earnings yield, also 7.1, and dividend yield about 3.5. So all three markets are very, very similar ballpark. The market's not really cheap right now if you compare the three, but historically, if the market's been at 18 and we're at 40 now, I still think there's opportunities. And what's been happening the last few weeks on the market, we saw this week also, we came very close to making another record high. The JSE is making new record highs all the time. There's money coming into South Africa, opportunities, and a lot to do with the retailers. But this is where the opportunities also might be lying for you and I, as small private investors. So at this point in time, it's moving sideways. This is what we call, on a relative strength basis, relative to the JSE All Share, what we call market perform. We're performing in line with the market. Okay, so it's those horses in the middle. At least the graph is not going straight down. We're not underperforming. Okay, so we might be taking a bit of a breather and waiting for new information, and we mightn't go up higher. Okay, so we're going to earnings season and things like that. So let's give what is the definition of a small cap? If you look at the definition they use in the States, it says that the generally accepted definition of a share is as a market capitalization between 250 million and 1 billion. You bring the exchange rate, multiply by, say, by 8.5, roughly by 2.2 to 8 billion, 8.5 billion rand. Okay, that's the American definition of the small caps. But obviously now we bring in the exchange rate, the difference there. So our definition, remember going back to the small caps, is anything, talking about 5 billion down to 338 billion, 308 million, sorry. Okay, 260 shares to choose from. At PSG Online, we consider anything not in the top 100 companies as a small cap. So it's a wealth, or you can say an ocean of opportunities to choose from. Okay, remember my analogy? These are the acorns, future oak trees. You're going to make you're going to make furniture out of them, and beautiful furniture. This is the opportunity here. This is the kind of thing you need in your portfolio. So talking about that, okay, why are they so popular? Okay, why are small caps so popular? Now I'm going to just highlight the big difference. Most private investors or the novice investors with a small portfolio say, hey, small caps are the perfect investment. Remember, the higher the potential returns, the higher the potential risk. Okay, so there's a big difference between a small cap and let's talk about penny shares. People like to go buy the 1 cent share. They think it goes from 1 cent to 2 cents to double your money. But that share was once upon a time 5 rand. And now it's 5 cents or 1 cent. In other words, the share price has dropped. That's what we call a dog. Stay away from a share like that. Okay, you're looking for a share that's got growth prospects. Company that's going to turn around and grow. The penny stocks, some of those companies, as I say, they do have a bad name. Avoid them. Okay, you're going to lose your money in those kind of shares. Okay, so we speculate. Those are the guys the people that buy into those little 1 cent shares or 5 cent shares. They are loss making. Those are the people that we call gamblers or speculators. They're not called traders. Traders are a different thing. These are speculators and gamblers. You might also go to the casino and place your money all red and black. It's exactly the same thing. You hope you're going to make money. When it comes to investing and trading on the market, hope is not a strategy. Okay? So you're not going to strike it rich. So I want you to become a sophisticated investor. We talk about being a sophisticated investor. I like the term a prudent investor. Someone who goes for high returns, but at low risk. Okay? So, sophisticated investor, you should have most of your investments in large cap stocks. Okay? Be it what you call the blue chip shares. Because these companies will be paying out increased dividends. Every year they grow, they'll be paying out dividends. Okay? They're safe. They're paying out dividends. And that dividends is income. You can reinvest back into your portfolio. And this is magic of compounding. You can get your portfolio to grow more, to grow faster. But the idea also is that have a small part of your portfolio involved in small cap stocks. Maybe 10%. Allocate 10% to that. Because the idea is that it gives you a balance to your portfolio. In the sense that, should one of those shares double, okay, it's going to have a big impact on your portfolio. One of those small cap stocks doubles. You'll see example now what I want to try and get to. Imagine just having one of those shares in your portfolio. Maybe having a few of them in your portfolio. Those are the kicker. You can call it your Powerball. Okay, it's going to give you your kick in your portfolio. But also, on the other hand, if that share drops, it's not going to be a big impact on your portfolio. Okay, so allocate 10% to these opportunities, little acorns. And you'll see my little image on the next graph where I highlight the opportunities. Now I'm highlighting a company called Capitec. Obviously we're a bit biased to it. PSG owns a big chunk of it. If you had bought right in the beginning, okay, when it was listed, they were founded in 1999. They were listed in February 2002. let's say, for example, you had 10,000 Rand and you bought a healthy chunk, roughly about 5,000 shares, because the shares were trading about 1 Rand 80. Okay? You bought roughly about 9,000 Rand worth of shares. Now let's say, for example, you forgot about them. You put them in the bottom drawer and you forgot about them. 10 years later, now this is on Tuesday, they were trading at 212 Rand a share. Okay? Again, not too shabby, huh? Okay. Now we're talking about at 5,000 shares at 212 Rand, your 10,000 Rand or your 9,000 Rand has just grown over to over 1 million Rand. Okay, in 10 years. Equivalent of over 11,000%. As I said, imagine just having one of these shares in your portfolio. Okay. Now that's just the capital growth. What about dividends? And that's another form of income coming in. Over the law, if you look at every single year, they start out paying out 19 cents. This is 19 cents per share, then 20 cents, as that goes on. Over the last 10 years, cumulative, roughly about 15 Rand per share. Now we add that onto our little performance. Okay, you've made another 75,000 Rand in dividends, tax-free. Okay, that's a little holiday by itself. Okay, so combined over 1.1 million. That was the potential a small cap share can do to your portfolio. Okay, now that's just one opportunity. So the challenge is, why small caps? Obviously the big institutions won't even look at it, but you as a private investor, why would you want to consider investing in small cap shares? Yes, that could be risky if you don't know what you're doing. Okay, the idea is that you're doing your homework, and I'll hop on it just now again. So the idea is with a small cap, they're smaller, they're nimble. Okay, they can exploit opportunities better. I presume some of you in this audience are small business owners. Okay, you don't have to call a committee meeting and a board meeting to have a decision about an opportunity. You see it and you grab it. Same thing with these small cap stock companies. Okay, they get together, their partners, make a quick decision, and they grab the opportunity. Okay, so they can take advantage of changes in the market. They're in a better position to generate earnings growth, as I say, because of that flexibility they have. Okay, they have more upside potential. A share goes from 1 Rand to 2 Rand, you double your money. Compared to a 100 Rand share to 200 Rand, it could take a bit longer. Okay, so you've got much more potential. But obviously the earnings also. The earnings go up 20%, same thing with the share price, can go up faster, 20%. Okay. So the thing with the institutions, the pension funds and these guys, they're not watching them. As I say, they're under the radar screen. And there's a lot of institutions that have analysts that will research the companies and things like that. So these companies are not being analyzed by the big research houses as such. So the thing is, analysts are not looking at it, number one. And number two is that information you see in the newspaper is also very limited. So news flow is poor. So you have to use a small private investor to dig a bit deeper and find out what does this company do and what's the nature of the business, etc. So obviously that won't be really reflected in the share price. So the company might be very profitable and it's flying, but it's not being reflected in the share price. And that's where the opportunity lies. You and I can see this and we can exploit it. Either the market overreacts to results or it underreacts. And this is where you can see and take advantage of that discrepancy. The thing is also, you and I as small private investors, we have the opportunity to analyze the financial statements of the company. So yes, it's easier to analyze. And I always use the example of Bidvest. Bidvest is one of the most difficult companies to analyze in the market. Why? Because Bidvest is not only one company. They have 500 companies. You have to analyze each one of those little companies. That's where the challenge lies. It's not an easy company to analyze. With a small or small cap stock, okay, they're easy to analyze because usually they operate within one line of business. Be it, I'm using a company like OneLogix. OneLogix has a company called VDS, Vehicle Delivery Systems. Those trucks that carry cars. They're in a niche market. Okay, you can compare them to the competitors and things like that. They also own a company called, a franchise called Postnet. But they have about 3 or 4 different businesses. It's not very difficult to analyze those different sectors as such, or different parts of their business. And also have a few major customers. So as I say, it's easier to compare or to analyze these kind of companies. They're cash generative, okay? And that's one of the very important things when you're looking at choosing a share, especially the small caps. As I say, some of those companies are dogs, they are loss making. You want to buy into a company that is not in debt, That's cash flow. Cash flow is king. Cash is king. And also you want to see a company as when I say managing debt, is they have interest cover that is more than 6 times cover. Okay, but cash is king. That's very, very important when you're choosing these shares. No cash flow, no business. No profits can lie. Cash can't lie. Okay. So they're not detracted by the rand. Whatever happens if the rand falls out of bed, goes up to 10 rand, they're not really affected as such. Okay, so they can get on doing their business. And you know, we talk about the large cap stocks being rand hedge stocks. These small caps are more domestic focused. We've seen what's happening in Eurozone, a lot of debt there, a lot of uncertainty. Here in South Africa, yes, we've had the strikes and truckers are back to work and things like that. But these small caps companies still going on doing business every day, domestically focused. There's opportunities, okay, and they're exploiting that. That's the reasons why you want to look at small caps. Okay. So how do you select a potential winner? This is the crux of the matter. So I've come up with 7, call it the secret 7s or the super 7s. 7 questions you need to ask yourself. The first question, as I mentioned now, is they must be growing. Okay, you're looking for growth, be it in earnings, but more importantly, are they growing in sales? Are they growing in turnover? And must be outperforming inflation. If not, they're going backwards. They're losing market share. Okay, they say inflation around about 6%. You know, conservatively, you say, okay, let's look at 10% plus. Okay, and that leads on to the next one. So with profit margins, obviously, the more I can charge for my product, the better. We talk about operating margins, the difference between the sales price and things like that. The idea is there with the operating margins, the higher my operating margins, anything above 10% is considered very, very good. I can defend my market share. Okay, I can protect my market share against additional competition. So in case a price war happens, I can compete. So I might drop from 10%, I might drop down to 9%, but I can defend it. Compared to a company like Pick n Pay and Shoprite, these guys where they're selling commodities, a toothpaste, Colgate toothpaste. Very, very similar prices in Pick n Pay and Shoprite. Okay, we're competing in price. So they haven't got much room to add extra price, extra onto it. Where if you've got your own product and you can add value to it, you can determine your own price. Okay, that's what I'm talking about when I talk about margins. Okay, so they have to have good operating margins, and ideally, as I say, a good company will have 10% plus. Now, a company's got say for example, a 2% margin, and their margins drop by 1%. They lose 50% on their profits. So that's where the challenge comes in. So the bigger your margins, the better. You've got room to move and you can defend your market share. Return on equity. Now this is looking at profitability. So this is compared, it's the profits owed to the shareholders divided by the shareholders' funds as a percentage. Again, comparing it, putting in money in the banks. This company gives me at least 15% plus, compared to putting in the banks at 5%. This is a much better investment. So you want to invest into a profitable business. Again, coming back to what I said just now about the dogs, those companies that are not making any profits, they make losses. Okay, they're loss making. They won't even have a RAE. Avoid those companies. It also is an indication of sustainability. Can this company grow every year? And that's the kind of thing you want to look at. Return on equity. Another question you ask yourself, the fourth question, as I said just now, cash is king. The company must be cash generative. It's the lifeblood of the business. No cash, no business. Okay. Very, very important, especially with the small cap stocks. You've got more room to move, you've got some cash. And when it comes to debt, now I can go to the banks and borrow money from the banks. Okay? The problem is when interest rates start rising, that means I have to pay my interest bill, less profits and things like that. So the idea is that I must have low or manageable debt. If it's out of control, I won't be able to survive when the economy starts shrinking or contracting. Okay? You don't go bankrupt when the cycle starts turning. Yeah, so that's also very important. Those are the two most important, I believe, when it comes to financial risk. People say, oh, small caps are risky. Okay? But let's get out of the way first of all. Let's look at cash and let's look at management, at debt. If it's manageable and they've got cash flow, then we say, yes, look at valuation, let's look at profitability. Okay. Is it paying a dividend? Remember, it's another bonus to you as a shareholder. Is it going to be paying a bonus? Now, I look at it this way, is the management philosophy behind it. If they're paying out a dividend, that means they have the interest of the shareholders at heart. Okay, they're paying you a dividend back. stay with us. Okay, we want you as a shareholder. Let's reward you as a shareholder. Okay, so they're running the company for the shareholders. And then lastly, is it a quality company? Now we talk about valuation and we also talk about quality. Another word for quality is safety. I spoke about the blue chip shares. A lot of those blue chip shares are quality companies because they've been around for a long time, they have consistent results and that kind of stuff. Okay? So we're talking about being a safe company. I'm not going into liquidation, quality, and we have a quality rating. You'll see a slide just now, we talk about quality rating. Anything above 60%, we say okay, it's a quality company. Below that, they're not consistent. One year they have profits, next year they have losses. One year so it goes on. You want something that's consistent. So that's what, these are the 7 questions you need to ask yourself as a small cap investor. Does it meet my criteria? So just as a share pick, we did a whole crunch down and I got to a stage where I chose as my share pick a company called Cashbuild. Has anybody heard of Cashbuild? Okay, some of us have seen the stores around. Most of us rather look at Builders Warehouse, where the case might be, which is Massmart. But it's a small cap company, 3.9 billion. On the outside of the top 100, they actually positioned around about 118 from the market, from a size point of view. Okay, but what is the nature of their business? Okay, they're the largest retailer of quality building materials and associated products. Okay, that's a niche market they're in. Okay, they're also looking at cash-paying customers. You go buy, you want to do some renovations to your house. Okay, you usually pay by credit card or take a loan, but you're paying them cash. Okay, so their market is typically the home builders, the renovators, the contractors, the farmers, the traders, but also the large construction companies. Okay, we spoke about Wilson Bailey just now and those kind of companies. They're also involved with government-related infrastructure development. So this is where these guys are positioned. This is what the nature of the business is. So something I can understand, it's tangible. Okay, I can see what they're doing. So that's their business. You can see what the revenue's been like over the last few years. That little table, that little bar graph, you can see it's steady growing. That's the kind of thing you're looking for, steady growth. That's on revenue. This is what they call operating margins. Yes, we've had a little dip. Okay, we've had a little dip, but now you can see it's improvement. So when you look at operating margins, the trend is important. So the last 3 years, you can see how it's been improving. So we were at 4.4, now we increased to 5.2, now most recently 6.3. Okay, so anything above 5% we consider very good. Okay, now you can see that trend, it's growing. Remember our dealer situation, 10% plus. But that gives you an idea of profitability and obviously growth potential. I'm not going to go into too much detail on here. I don't want you to read too much, but I'll focus more on the table as such. They had a good set of results until the end of June. It's 53 weeks, so it's an additional week for the operating year. It was tough, obviously, in that economic environment. It's been tough for them. They had selling price inflation. Remember, all their prices have increased by 3% also, so they had to take that into consideration. But their revenue grew by 11%, which is outperforming inflation, that we were looking at just now. So they grew their turnover or their sales by 11% to 6.3 billion. They've got 182 pre-existing stores, which contributed 10% of that 11%. And then they had another 9 stores that opened since July that contributed another 1%. So obviously these other 9 new stores can also still contribute going forward. The gross profit increased by 16%, higher than inflation. The gross profit margin, 23%, compared to the previous year, 22.5%. Again, it's just improvement. Lots of improvement, lots of growth. That's the kind of thing you're looking for. The operating profit before depreciation grew by 33%. Okay? The biggest cost as such was the people cost. Okay, the staff salaries and things like that. Remember, that's something you can to a certain extent control. But that was the biggest the cost component. Depreciating expense increased by 16%, and then operating profit increased by 37%. All these numbers, all it matters is more than inflation and these growth. That's the kind of thing you're looking for. Operating margins increased, as I say, to 6.3 from 5.2. So that trend is up. All these trends are up. That's the kind of thing you're looking for. Doesn't meet my criteria? Yes, 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 yes. Finance income, so they might have, they might have some borrowings, but in this situation it's net finance income. So instead of paying out, they actually got money coming in the form of interest. they increased by 13%. The earnings before tax increased by 32%. So we're just chunking right down on the income statement, right down to the bottom. So what is their profit? Their headline earnings. This is obviously the way we look at earnings in South Africa. We talk about the HEPS. Headline earnings per share grew by 37%. So as a per share value, okay, from 9 Rand 16 to 12 Rand. Okay, you see how that growth has been growing. Okay, the first half of that profit, 50%, 52% was contributed from the first half. So obviously the first half of the year is where they get most of their business from. Basic earnings jumped by 91%. Now you'll see on the graph just now, when you look at the PE ratio and the earnings yield, you'll see this sharp movement. Why? It's got a lot to do with, in the previous year, they had a 56 million Rand, what they call non-recurring debt. It was a BE transaction. It wasn't repeated in the next year. And hence they had more profits. And that's why the basic earnings jumped by 91%. Cash generation was poor. Why? It's a timing issue. Just before the year end, they had to pay a lot of these suppliers. You'll see on the table just now, the cash flow will be negative. Okay. Oops, sorry, let's go back. Okay. Out of that earnings, they paid 273 or 273 cents in dividends. Okay. The total dividend for the year, 569 cents. But now, here as a South African, we get taxed now on our dividends. So after dividend withholding tax, okay, less than 15%. Out of that 273 cents, we're getting 232 cents. That's after tax. Not too shabby. You know, again, if you had 1,000 shares, that's 2,300 Rand. You're getting tax free. Okay, you can reinvest back into your portfolio. Now this is the graph. The same thing with all those numbers you saw now. I've just put it in a little table. What's the predominant color you see? Lots of greens. That's what you're going to see when you're looking at analyzing these companies. A lot of green. Always says like a traffic light. Green means go invest, go invest. Okay. So the only little red you can see there is the cash flow, but we know why. It's a timing issue, which is where they were paying the suppliers. But they are very cash generative generally. 1.5 on the cash flow rating. They are on the P ratio 12.7, when the market's about 14. Price NAV 4.1. So yes, they're starting slightly higher. I like to look at price NAV anything below 2. But you see why, because the return on equity is very, very high. Okay, 41%, so that will justify that kind of rating. On the PEG ratio, we still say that's fairly valued. Okay. So this is all sourced from a company called IFR, a company that works with us at PSG Online. They're independent fundamental research. They read the same research that you see in the newspaper, and they comment on it. And that's where all this information comes from. They also give a recommendation. So the group's high return on equity, strong cash generation, and obviously a strong balance sheet it has, and it's indicative of the company's strength going forward and the potential going forward. So this is a winner that you want to look into. But also its niche market where it's in, it's also defensive. Okay. The historical PE and the dividend yield is attractive. However, we say the share is fairly valued right now. It's not undervalued. Okay, and hence we give a recommendation on this share. If you're a current shareholder, will be a hold. You'll see the graph now, how the share's been performing for the last 12 years. Okay? That is the price performance. We went from 3 Rand 70 a share way back in 2012, and most recently now we hit about 160 Rand a share. And this is still a small cap stock. Okay? We're talking about 220% per annum. Having one of these shares in your portfolio, more than doubling twice. That has a big influence on your portfolio. That's the kind of thing you're looking for. As I say, that's what I was talking about, that little that drop, okay, because the earnings jumped up so much. And obviously when the earnings jumped up so much compared to the previous year, because of that BE deal, that's why the graph gets skewed. But then the market, the market recovers, or the share price recovers, what they call back to a normalized PE ratio. Okay, so we run about a 12 PE. Okay. Look at that from a relative strength point of view. It's outperforming. This is the horses right near the front of the race. This is the horses you want to bet on. These are potential winners. Okay. So I'm like a horse race commentator. Okay. But that's the kind of thing you're looking for. These are the winners, the strong shares you want to have in your portfolio. Okay. So coming back to my 7 questions. Does it have growing turnover? Does it have good operating margins, high return on equity, good cash generator? Is it paying dividends? Is it a quality company? And the way I look at it, I say yes. Okay, not only that, from a valuation point of view, okay, to say it's not cheap, it's not a screaming buy, it's not undervalued, so it's fair, we say it's fairly valued. They're still paying a very good dividend, 3.6%. So based on that, and because it's a small cap stock, it's the kind of share I like to have in my portfolio. Okay. So in quick summary, mid cap stocks, these are the next in line. They say they're in the second place on the podium, they want to move to the first place. Remember, it's not a competition as such, but they can move up. We saw now Mr. Price, they can move on to the large cap stocks, onto the radar screens of the institutions. Remember, you want to get in right at the bottom, the mezzanine floor, the acorn, to get to that stage. Okay, so the PE ratio on that sector, 13.8, 3.21 on dividend yield. Small caps, anything not in the top 100 companies, and they say under the radar, this is one of the shares you want to pick up on. So yes, as a small private investor, okay, you need to have patience. You need to wait. Okay? Okay, so remember the benefits, huge potential gains, a smaller, nimble, gives you natural diversification for your portfolio. They're easy to analyze because they're, as I say, they're not so diverse as Bidvest. And obviously in a much better position to generate growth. Okay, so in conclusion, do your homework always. Don't just go buy a share of the tip. With the tip, there's a tap. Ask those questions. Okay. You're betting the odds in your favor when you do your homework. When you just go out and go buy the share on the worm without doing any homework, you're a speculator or a gambler. Okay, you want to be an investor, do your homework. Okay. So it just takes one big investment, one big turnover. You know, it gets into the top, into the large cap stocks or the mid cap stocks. More institutions start nibbling it because the institutions do have funds that focus on mid cap and small cap stocks. Okay, so they just start nibbling onto it. Now this obviously moves the price up higher. You just need a big company like Investec or Cadis, whatever the case might be, becoming a big part in that, pushes that share higher. And lastly, remember Capitec. That's the kind of thing you want to strive for, trying to find a future Capitec. Okay, that's how you get the winners. Okay. I'm at the end of my presentation. Just give you a quick highlight of what PC does. Those of you that want to get involved in buying into these small cap stocks, ESG has the opportunity, you have a platform to buy into the shares, into single stock futures. You can go buy into Capitec and into as a single stock future or as a CFD. So there's various ways of having exposure to the mid caps and the large cap stocks. We only trade the top 100 companies. You also have the opportunity to trade currency futures, commodity futures. We have a script-free loan facility. You've got a portfolio with us in the large cap stocks. We allow you to borrow 3% against that. There's no balance sheets involved and things like that. We have technical analysis software available for you. We have a platform for unit trust. We have a platform for exchange traded funds. Through us also you can trade offshore. Okay, you can also have a cash manager. So we have a wealth of financial products through one username, one platform, all these financial products. That's what we offer. BSG, we've just been voted Stockbroker of the Year again, 2 years in a row now. So we offer a broad range of financial products. Yes, we have a trading platform. You saw some of the research available on our platforms. We have all that research available. You can also go scan the market and say, okay, I'm looking, this is my criteria. Based on those 7 questions I asked, these are my criteria, find me the shares. Big time saver, that's what the platform does. We have a Mobi website. We have an app that you can download onto your iPhone and to your iPad. Okay? We keep regular news updates, what moves the market. We write daily market reports for our traders. Where's opportunities? You have DMA, direct market access. There's no, you place them all in the market, there's no broker, no one's looking at your funds and there's a hold up, it goes straight into the market, that's straight away. And so also we have mobility, we're an online company. You have mobility anywhere 24/7. I've traded the share market from internet cafe in Mexico. Okay, so you can trade anywhere in the world. And we have leading technology on that. As I say, I head up Investor Education. I have a wealth of information available for free on our website, tutorials. I do what I call MarketWorks, a day seminar. In November will be our next one. It's a day seminar, including lunch, 200 Rand. Okay, I'm not here to make money from the seminar. I want to empower you to make better decisions so you can make money. And if you're making money in the market, it's a win-win situation. Okay. PC Online, we're online brokers, but we have advisory offices around the country. So there are financial advisors who will sit down with you and help you structure your portfolio. And lastly, obviously, you can stay in touch with us. Our website, we've got a news portal, a blog. You can follow us on our Twitter. There's our handle. There's Facebook and also YouTube. At our store, you'll see the video going at the moment with me. I did some video training. It's recorded. It's available on YouTube. Everything you need to know to get started on the stock market. Okay. 1 or 2 questions? Look very close up. Good question. How do you find liquidity? Very important question. From a trading point of view, my background is such, I'm a technical analyst. The first thing I always look at is the graphs, the charts. You want volatility. You want that little spikiness in the graph. If you look at the graph and it's flat, it's what I call Manhattan skyline or Yellow skyline. Looks like buildings. Those are the shares you want to avoid. So rule of thumb, if I want to buy 1,000 shares, okay, I must trade at least 3 times more than I want to buy. So I must trade on average 3,000 shares. That's one way of getting around liquidity. But yes, you saw some of those companies are small. Okay, most of those small cap stock companies, the management, the owners of the business are the main shareholders. So yes, some of them are tightly held. So yeah, but that's one way to look at it, is look at the graphs to answer your question. Okay, anybody else? Back here?
Thank you. I'd like to know, what do you think of the energy sector? And you were talking about the small caps, and also like to know examples of companies involved in the energy sector. And by energy, I mean solar, I mean renewable energy, since it seems like it's the next coming trend that will boom.
Sure, it is the next potential sector to boom. Unfortunately, there's none of those companies listed on the market right now that I know offhand. Now, the energy companies that will come to mind would be the Sasol, which is they're looking at gas, converting coal to gas and that kind of stuff. Alternatively, is the coal companies. But to answer your question about solar energy, there's nothing listed on the market at this point in time. They're still greenfield operations. And obviously that's one way for them to come to the market is to raise more capital. So yeah, as soon as those companies come to the market, those are the opportunities. But unfortunately, nothing at this point in time. Okay. Guys, from my side, thank you very much. Thanks for your time. Thanks for your interest. Good luck and happy trading.